Hello everyone. I'm checking my last bits on technology. Let me know if the sound is okay and if the picture is okay. Let me check that real quick. So for picture to be alright, you should use 720p here, and it should be visible, and that's it. Okay, so first part of today is a recap of module 4 here in the schedule. If you forgot how schedule, where is schedule located, I will share the link to here. And in our module 4 we did inventory, cost of goods sold, and we also have a link to MIT materials on that topic. So okay, let's just do a quick recap about that. If you have any questions regarding homework or regarding any of your transactions, let me know. We will take a look in the homework today as well. I just wanted to do a recap because quite a bit of time passed since we did that material. So to figure out inventory, to figure out cost of sales, we need figuring out cost of sales has a lot to do with inventories. Let me find inventory roll forward, cost of sales roll forward. Okay, module 4, did I put it here? Okay, I will use IRS roll forward for that purposes. Accounting roll forward looks the same. So to figure out what our cost of goods sold was, we need an opening inventory, and we need it to be valued appropriately. Otherwise, we have some errors in the previous period, and we will roll these errors in our current period. So we start with opening inventory. We add purchases. So whatever we purchased into our inventory. Then we add cost of labor. Then we add other materials and supplies, and as well as other costs. And if we add all of that, we got some number, which is cost not adjusted for the closing inventory. And then we have closing inventory at the end. And we also need to value that closing inventory. And by deducting from that line, if we deduct from that line, we get our cost of sales. Now let's imagine if we have 0 here, we have no inventory left. Then our cost of goods sold in the period is what we have at the beginning of the period, plus all of these items: purchases, materials, labor, all of that. It is a complicated accounting task to allocate costs to inventory. So it's a big area. We won't explore it in much detail right now. Maybe we will do it later. MIT lectures have have some insights on that topic. So if you go to MIT lectures and scroll down to here, you will find lectures on introduction to cost concepts, indirect allocation of costs. They also have some case study here. So material is available. If you want, you can study it right now yourself, or you can wait while we will cover it later. So this is our cost of sales roll forward. So the bigger ending inventory we have, the less our cost of goods sold are, and the better our profit is. The less inventories at the year end, the more our cost of goods sold are. So what challenges do we have here? Of course, the first challenge is in the first line. Was the opening inventory correct? And if not, what to do about that? We also might have challenges figuring out what purchases do we need to allocate to, let's just call it allocation of purchases to cost of sales. And the example we are looking at, it mostly concerns production, manufacturing, when we deal with inventory and finished goods. In a service business, it might be a bit easier to match whatever service you do and whatever expenses are related to that service. As you can remember from previous lectures, there is a matching concept in accounting. Let me just pick up some definition about that. What is matching principle? So basically you need to match your revenues and your expenses. For example, if you do a service and you buy some stuff to perform that service, but you haven't performed the service yet and you haven't earned the revenue yet, the stuff which you bought is usually shouldn't be expensed until you perform the service. But that might be tricky. So something can be deferred until you realize revenue. So what do we have here? Matching principle is an accounting principle that requires that expenses incurred during a period be recorded in the same period in which the related revenues are earned. This principle recognizes that businesses must incur expenses to earn revenues. Okay. And all of that, so all of we are looking at now in the cost of goods sold, it relates to the matching principles. So otherwise, the alternative to that roll forward, for example, if you use specific identification method for inventories. So if you sell some unit of inventory, and if you know what the cost of that unit of inventory was, you can expense the exact cost of that inventory. It will depend. If you sell just a few inventories during the period and you know the cost of each, you can just expense the cost of each exact unit of the inventory when you sell it, and you will not have to deal much with like inventory valuation. But most of the time you will have to do something like that to figure out your cost of sales. So we have a challenge here. Was it calculated properly? Then purchases. classification and capitalization to inventory cost. Then we have cost of labor. It's basically the same classification, which is how we separate cost of goods sold and G&A, and the same capitalization. Most of the production costs should be capitalized, as well as warehousing costs. Materials and supplies, it's basically all the same. So whether we allocate it to cost of sales and whether we capitalize it into inventory cost. As you can see from that point, every line in cost of goods sold is related to inventories. So one question is inventory related, and second question is whether it is cost of sales or whether it is like SG&A. And the answer to the first question is also somewhat covered in the inventory standard. We have a situation that in GAAP, in US GAAP and in IFRS, we do not have specific inventory statement. We do not have specific standard on cost of sales. We have standard on inventory. Let's open it. Okay, I'm sharing the link here. Is for all who are present, is this new information or is it already clear, or maybe you want me to shift to some other tasks related to module 4? Currently I'm just doing a recap of what we have learned. So basically there is no GAAP standard on cost of sales. Sometimes there are very limited requirements or recommendations, or Securities and Exchange Commission can have some little preferences around that. But overall GAAP tells you that your cost of goods sold. So in GAAP we give you instructions on how to calculate balances, like inventory balances. You measure the purchases during the period using accrual basis of accounting, and you measure ending inventory, and cost of goods sold is whatever balances all of the other measurements. So basically they let's go back here. So GAAP basically says let's see how GAAP addresses inventory. So use inventory standard. So we use inventory standard to measure that. We use inventory standard to measure that. Then here we say use inventory standard accrual basis and some judgment for classification. Okay, and again, as you see, most of the stuff has to deal with inventory standard. However, for example, for labor cost, you can get some other GAAP standards involved. For example, if you pay a stock-based compensation, if you issue stock options to some of your labor, you will have to measure that differently. Or if you for example allocate depreciation, that will be standard on property, plant and equipment. Do you hear my kids screaming on the background? If you do, I might decrease the sensitivity of my microphone. Is sound okay? Do you hear me clearly? So microphone is working. Okay, let me know if there are any issues with the translation and if I can do better. So basically, here it is. Most of the cost of goods sold is related to inventory valuation. And inventory valuation is that accounting standard. Is picture quality okay? Give me a second. Okay, it looks okay. Okay, so inventory standard. What we need to do with inventory? Let's go back to our file. We need to know quantity do regular stock counts. Second, know quality. It can be part of the quantity. So assess obsolescence. So we assess obsolescence and we assess spoilage, all of that stuff. We usually do it also as a part of stock count or inventory observation. Third, we need to know cost. Use inventory standard plus cost accounting. And fourth, when we know cost, know NRV, net realizable value, selling price less cost to sell. If NRV below cost, that means you need to write down. So if per your stock count you figure out that your quantity of inventories is less than you have on the books, you need to write down. if you, during your stock count, you figure out that some items spoiled or become obsolete or become damaged, you need to write down the value of your inventory. You need to know how to calculate cost, and that's a whole big deal of absorption costing, all of different costing techniques. And inventory standard also has its takes for it. And you also need to know which expenses you can capitalize into inventory cost. And let's also add it here. And when you calculated the cost, you need to make sure that your cost is not higher than your net realizable value. So if you think with the costs that you calculated that you're going to sell your inventories with some loss, in that case, you need to write down your inventory. So basically, first two exercises usually do not require you any like accounting knowledge. It is just common sense. Maybe you will exercise some judgment when you determine the write down for obsolete or damaged inventory. Maybe you do not write down them to 0. But for this part, you will need kind of a very good knowledge of cost accounting. And for this part, it will be enough to know inventory standard and be ready to read it. Okay, so let's take a quick look at the inventory standard. So we have like a definition of inventory here, and these are basically the items which are either held for sale in the ordinary, so whatever you are selling in the ordinary course of business. For example, if you manufacture spare parts are your inventory. If you do like flipping, if you do house flipping or construction business, houses can actually be your inventory. In some situation, real estate will be your property, plant and equipment. If you use it in your business or production and you keep it for long term. But if you sell houses or flip houses, your property can actually be like an inventory for you, and you will apply different standards compared. So in one case you will apply property, plant and equipment, in the other case you will apply inventory. And whatever is consumed in the process of production, and whatever is like a work in progress. So we do not need to know about consignments. Then we have like inventory costing techniques. And apart, so let's go here. What we cannot here. So for inventory costing, we need to know first what costs to allocate to inventory. Then we need to know how to allocate those costs. Let me see. Okay, costing example. Okay, let me add some more here. So first, what costs to allocate to inventory? And that is C inventory standard. Second part will be how to allocate those costs to finished goods, work in progress, each item of production. So imagine if you have some complex process in manufacturing when you manufacture batches of some products, and sometimes these are different products. Let's imagine some milk processing. So you get milk, then you perform some processes over the milk, like you produce cheese, butter, some other liquids, yogurts, and all of them may share some parts of the manufacturing. For some processes, they may share the process. So for some processes, they will have different processes, and all of that is dealt with by cost accounting. For example, okay, so we decided what we want to allocate to inventory. Then we decided how to allocate it to each exact value. Then we apply cost. Let's see how they call it in the standard. Cost flow assumptions. FIFO, LIFO, weighted average, maybe a specific, but I do not see that defined in the standard, but internet search says that you kind of can use specific identification method. Okay, and that's also covered in the inventory standard. Basically, first in, first out is when you sell the inventory, you assume that you are selling the inventory which you bought, like the first in the line. I have some schedules done here which show you like examples. So for example, FIFO, first in, first out. Here we bought 100 items for $20 per item, sold some. We also sold them at $20, get some closing inventory. Then we purchased additional items at $15 and we sold 50, but we sold all those 50 at $20 because we used first in, first out assumption, and we have still a stock of these $20 items. Actual items which you sell can be different. You can actually pick up some of these $15 items. These are all the same items. So the essence of the product, it is the same product, but you pay different prices to supplier. And when you sell those 50, you could have actually picked up some of these and some of these, but you use a cost flow assumption FIFO. So in your accounting, you use $20 until all that 100 is exhausted. So you get some closing inventory, then you sell some extra, and you take remaining 20 items at 20 and 10 at 15, and you have 10 items left, and they are left at the cost of $15. That's because you see your last purchase was at 15 and it was 20, and you have only 10 left, and that 10 is valued at 15. So that is first in, first out assumption. Here I did a bit of unusual exercise, unusual situation, because usually prices increase with time because of inflation, and using FIFO, your inventory at the period end should be valued higher. It should be usually valued higher than your earlier purchases. But it is what it is. I did it on a opposite basis. Hopefully you will remember that FIFO produce the highest inventory value at the end of the period, and LIFO produces the lowest inventory. And let's see how does it impact cost of sales. So here is our roll forward. Imagine that we use FIFO. If we use FIFO, and which in general produces us the highest cost of inventory. Let's say we ended up with 20,000 of inventory. And with that 20,000 of inventory, closing inventory, our cost of goods sold is only 20,000. Now, if we use LIFO, and let's assume it gives us 12,000 of inventory. So our cost of goods sold is 28,000. So LIFO is very good for taxes because it increases your cost of sales and it decreases the value of your inventory. And during one of the previous sessions, I received a question in the Q&A which I didn't have the answer for. Let's see. LIFO versus FIFO share in USA. I didn't find the exact numbers, but I found interesting presentation about LIFO reserve. So basically companies use LIFO method to save on taxes, to increase their cost in current period and to keep their inventory at the lowest value. And there is such thing as LIFO reserve. And LIFO reserve is a difference between FIFO valuation and LIFO valuation. So as you can see, ExxonMobil, I believe it is 2009 data, but I don't think that things changed much. So LIFO reserve, $25 billion, 10% of ExxonMobil total assets. ExxonMobil is the biggest oil company, is the biggest public, Saudi Aramco is also public. So the biggest oil company in the world after Saudi Aramco. So they have $25 billion LIFO reserve. So as if they valued their inventory at FIFO, their inventory would have been $25 billion higher. And they basically increased over their history, they increased their value, their cost of goods sold by $25 billion. And that translated into some like a $5 billion in tax savings. And most of the critique around LIFO reserve is that it allows to save you quite a bit on taxes. So let's return for a second here. I actually try to copy that image to my lectures. Okay, so and here is the LIFO. The situation is basically the same the quantity movement is the same with compared with FIFO, but we are ending up with closing inventory at the price of our earliest purchase of the material in this situation. Now if we sell all our LIFO inventory, our calculation will reset. So you cannot just say that cost of your LIFO item will always be your first historical purchase of that material. If at some point we just sell everything to zero, then it will reset and we will start from scratch. And we also have weighted average, which basically averages everything for you. Just an example why it might be important. QBO inventory flow. Okay, QBO uses FIFO. So the software in which we practice, in which we do our practice, it uses FIFO method, and it is the only available method in that software. But overall, QuickBooks Online is no good for companies with major inventories. If you do some production and you capitalize costs, you probably shouldn't use QuickBooks Online. Or you can try to get some extensions or extra apps to manage your inventory, and you do only like a general, like a journal and one journal entry for all of your inventory. QuickBooks Online will not allocate your costs to inventories in any way. You will have to do all of that by hand. Okay, so let's go back where I was doing that work. Here. Okay. What costs? So we just covered cost flow assumptions. Now, what costs to allocate to inventory? And these are the answers. The inventory standard has like a huge table which will tell you which costs you can allocate to inventory. And here it is, full absorption costing. And they are called inventoriable costs. So you can see that materials and supplies usually, of course, you will have to apply some of your judgment and try not to manipulate your financials. That's why they say that it is usually an inventoriable cost and not usually an inventoriable cost. They do not give you a 100% certain framework to allocate anything. You still have to apply judgment. So materials and supplies, tools and equipment, cost of quality control. But if you do some scrapping, spoilage or rework, you expense it in the period when you do it. You do not capitalize that costs. Or casualty or theft. Then distribution and warehousing. If you keep warehouses and you distribute your goods through those warehouses, you usually capitalize the cost related to such distribution. But you do not capitalize, for example, shipping to customer. So if you ship your inventory to your warehouse somewhere, you capitalize that expense. But if you ship your inventory to a customer, you usually expense that shipping costs. If the sale has occurred. If not, there might be something to think about in this case. But if you sold the item, you just recognize an expense for distribution to customer. For distribution to your warehouse, you capitalize the costs. Vendor rebates and other credits, you usually adjust for vendor rebates, but it has explanation about possible option to not to adjust for vendor rebate. Depreciation, you calculate, you allocate depreciation, which you incurred because of production and manufacturing. Cost depletion, it's almost same as depreciation. Repairs and maintenance. You also capitalize it. Utilities, rent, bidding costs. So for some reason they do not allow you to capitalize that, but that's in case when you buy something off the auction. Engineering and design, it's arguable, but research and development is not capitalized on inventories, and the engineering which relates to research and development is not capitalized. Factory admin expenses capitalized, insurance related to production capitalized, marketing selling expenses not capitalized, labor and supervisory labors capitalized, pension costs capitalized. So basically there is pretty exhaustive list. Let's go to our file, see inventory standard. So you exercise your judgment to determine what costs can be capitalized. Then you use cost accounting to allocate those costs to your different inventory items. If you have simple inventory process and you just have one, you for example buy one product and sell one product, and you do not do any transformations with your inventory, you will still have to capitalize some inbound shipping. If you have a warehouse and you have some shipping expenses, you can capitalize those shipping expenses. As well, you might need to capitalize your warehousing costs. Let's see in the cost here. I remember I saw the warehousing costs here. So distribution and warehousing costs, finished goods. So you allocate your warehousing to the cost to the finished goods. And if you keep inventory, let's say, what an example we can have here. So you bought items. Okay, I already have an example here. Chinese supplier for mattresses. We bought, the price is China is $100. Then we have shipping to port and loading. Then we have shipping price. So price on ship, FOB basis, $120. Then we have freight to United States. Then we have price and United States port, $140. Then we have duties on that. Then we have tracking to our warehouse. Then we have cost at our, at our warehouse. But at plant, if it's just some raw materials, it can be plant. Okay. We have some handling related to these mattresses. Then we have some other labor involved, some packaging, and I also have something here, but I deleted. Other, let's call it other. And we end up with that inventory costs. Let's call it allocated warehouse allocated monthly warehouses cost. For example, to keep those mattresses in the warehouse, you kind of incurred monthly warehousing costs. And in theory, you can probably capitalize all of those. So if you do not move your mattresses and you keep them and your net realizable value is much higher, it's higher than whatever you have is in the cost, you can capitalize like every month your warehousing costs. But that's in case you are not moving your inventories around. If you move, if you start to sell your inventories, your cost flow assumptions will kick in, and you will have to deal with that. Any questions? I see we have only like 10 minutes left. Let's go check some homeworks. Okay, we have already checked whatever was done for the homework. Does anyone have any specific questions related to the homework? Next lecture will be about cash flow, and I believe I prepared some interesting material for the cash flow lectures. But just ask me a question. Let's see. While I'm waiting for the question, I can show you that I added cash flow lecture for today. It will be 3 lectures. The last one will be more practical one when we work in our homework files to create a cash flow. And then we will have some practice related to cash flow and homework. And then on December 11, we will have property, plant and equipment modules. And then we will go for another holidays with some practical exercises. We will basically do assignments and exams from MIT. So MIT has some problem sets. We will cover everything up to 4th problem set, and we will cover midterm 1 exam for that part. Okay, all clear. Homework 4. Did I miss anything in the homework 4? Okay, I probably haven't done video on expense prepay, and I also haven't done a separate video on inventory NRV. I promise I will do that. Let's see if I can answer any questions here. Oh, I remembered. There was a question. What accounts I used in trial balance for payroll expenses, and whether we show individual part of federal income tax and social security contributions on in our financials, in our trail balance, whether we have separate accounts for federal income taxes and social security contributions, which are responsibility of the individual, and also about 401k matching if it's processed by the payroll provider. So I checked in our company, and yes, matching for 401k. Let me add here that example. 401k matching is processed by payroll provider, and employee portion of federal tax and social security tax, FICA, is included in gross payroll expense. There is no separate accounts for that. So we do not monitor that. We just send the money to payroll processor. However, I added a list of our payroll accounts, and as you can see, there is a lot of stuff. There is a lot of stuff related to payroll which is monitored. You can have like a hourly pay. Oops, sorry, not. You can have hourly pay, and you can have also like salary wages. And let me make it orange too. And you have like bonuses, payroll taxes, but these are employers. You have workers' comp, which is kind of like insurance, some insurance. You can have other insurance. You may have other different parts, contract labor, black lung. We are a mining company, we have black lung. We have some stuff related to physicals, overtime. So all of these, why do we have so many accounts? That's because these expenses might be used in one or another way to make managerial decisions. For example, for overtime, in the situations when our production costs a lot, not costs, market values it for a lot. If the market prices are good, we might want to ask our employees to work some overtimes, and of course we have to pay that. And overtime wages are usually higher than regular wages, and we need to be able to analyze when is it profitable to us to work overtime and produce products, or when we just should produce products in regular hours. Sometimes overtime is like not avoidable. For example, we have a mine where the road to the mining place and back will take workers like couple of hours or maybe an hour, and we also have to maintain the length of the shift to work productively. So workers like incur overtime by default because they need time to get to inside the mine. Employee relocation. You might also have some expenses here for some discretionary items. Disability, gifts, 401k matching here, scheduled, unscheduled overtime, extra shift pay, vehicle allowance, tool allowance, training, personal earnings, like a lot of stuff, production bonuses. So you also monitor bonuses differently because it is a big kind of component of your accruals. You accrue bonuses, you make a lot of assumptions, and you accrue bonuses during the year, and you pay them only once a year. And if you are very wrong with your assumptions, you might end up with an incorrect accrual. And since we have a lot of expense account, we also have a lot of balance sheet account where we accrue these items before they are paid. But balance sheet accounts are less important for managerial analysis. So management is mostly concerned around profit and loss, but balance sheet might be useful to actually, by the way, calculate cash flows. So management is not only concerned with the expense assumptions, they will also concern about cash flows. And to figure out cash flow, you need to take your expense and adjust it for the fluctuation in the balance. But that's the topic of our next lecture, which will start in 5 minutes. Let's see if I can send you a link here. Maybe 5 or a bit more, depending on how quick I can do that. I will take some time to shift between the lectures. Next lecture on cash flow in 5-7 minutes. Okay, thank you and see you on the next lecture. It should be a very good lecture. I prepared a lot for that lecture.